When I talk about business entities, from the taxation angle, there are three different taxation impact. And when I look at the tax forms later, I am going to talk from the perspective of taxation in three different ways. Now, the first kind of entity are termed as disregarded business entity, which simply means if, let's say, A and B, if A is organizing a business, okay, so if A, let's set up, A sets up its some kind of an organization, A is enterprise. So what is it? Typically, you will see most of these kirana shops, the local mom and pop stores. These are the people who would be organizing their business as sole proprietors. What is the biggest advantage? I am my own boss. It's a small business, and I can run my show the way I want. What is the biggest disadvantage? The biggest disadvantage is that I cannot, so have the company being survived after I'm no longer there. So the day when the sole proprietor dies, the entity loses its identity. Now, from the taxation angle, a sole proprietorship is not considered a separate business entity. That means the person A and the business A both would be regarded as one entity. Now, understand we are doing business taxation. That means we are going to concentrate only on the business aspect, right? So, when I have my business and I'm running as a sole proprietorship, what I'm essentially saying is that IRS will say, no, this is not a business. This is you. So, A and the business has no separate legal identity. So, what forms do you have to fill up? You will have to fill up a form which is typically a 1040 Schedule C, which means you will fill up your sole proprietorship. So, 1040, which is your individual taxation form. So, just like we have capital gains and Schedule B, which is your interest income, and Schedule A, where you have your itemized deduction, just like any other item, the money that you're earning from your business will be reported in your personal taxation, and you're going to pay a slab rate of tax on it. What is the highest income tax rate, guys? What is the highest income tax rate in the US for individuals? Yes, I think by now, answer in the chat panel. I think just 1 second, I'll just buzz Shreyas and find out. What is the highest tax slab? It's not 40%, it's 37%, Manali, right? It's 37%. Okay. So we have a tax slab. Is it an absolute percentage? The answer is no. It is a relative. So if I look at the effective tax rate, which is the total tax divided by the base, the taxable income, it will come definitely lower than 37% because we have a graded structure of taxation. And here your filing status and everything comes into consideration. Then we have the second kind of entities. Okay. Now, why are these entities very important? We'll talk about what is the different forms of partnerships also. But as of now, I wanted to understand what's the flow through taxation. What is a flow through business entity? Entities where taxation flows through. So typically, this is how the business would run like. We have A, we have B. So this is partner A, this is partner B. And let's say they have AB partnership. This is their partnership business. Okay. So the way taxation in the US is going to be governed, AB partnership will file something called Form 1065, which is essentially an information return, which means there is nobody who will be paying tax for AB partnership. It is just an entity which we are informing to the IRS that see there was a business enterprise that we formed, but we are running it as partners, and this is the total income that the business earned, and this is the total expense that a business earned. So let's assume the business earned 100 and the business spent, let's say, 120, and they had 80 rupees as profit. So AB Enterprise is not a separate tax-paying entity. AB Enterprise is just an information return. So basically, AB Enterprise is again not regarded as a separate tax-paying entity. That means this 80 will definitely be reported on Form 1065, but it is just for letting the IRS know that, see, this is what a partnership has got. So who would pay tax on 80? This 80 would actually get distributed in the profit sharing ratio to A and B. And if we are assuming a 1:1 profit sharing ratio, A will get 40, B will get 40, and then A will pay tax on 40 in his or her income tax return. And again, B will pay tax on his or her income tax return. In other words, the income flows through from partnership in the hands of the partners and they pay tax on it. So there you have the whole concept of Schedule E where the tax would be paid. So just like partnership. So is partnership a separate tax paying entity? The answer is no. Who pays the tax? The partners. So income generated via a form of business called partnership flows through from the partners in the hands of the individual partnership in the hands of the individual partners, and they go ahead and pay tax on that income. So, what is the due date? That's the next thing we're going to learn in very. So, right now, I just wanted to understand what is the difference between each of these forms of businesses. So, if you look at this, what is partnership? So, partnership is essentially going to file Form 1065, but the income would eventually flow out from the partners. From the partnership to the partners, and they will include that income in their 1040 and pay tax on it. So, did we have double taxation for partners? At any point of time, are two people paying tax? Or are there two incidents of tax in partnership? The answer is no. A partnership is not paying tax. It is only the partners who are paying tax. So, there is only one taxation for partnership. Then we have S Corps. Now, these are small private limited companies. So, in India, we colloquially refer to them as private limited companies. 1 second, guys. Uh, 1 second, okay? I think 1 second, guys, okay? Yeah. So we have only one tax-paying entity, which is the partnership. Now we have the S corps. What are the S corps? These are similar to private limited companies in India. Now, see, the problem with sole proprietorships and partnerships are that they have unlimited liability. That means if A and B form a business, and if A and B runs a partnership, then if partnership takes a loan which partnership is not able to pay, then A and B can be asked to pay that loan from their individual bank account. So their personal assets can be seized. Now we are going to talk about different ways by which this problem has been tried to be encountered. So now we have not only a general partnership, we have something called an LLP also. So to some extent, we have tried to cover up that problem. Then we have these S corps. These are in India we call them private limited companies. Okay, so these are what? These are small companies, and the idea is that we are not going to go to the IPO to raise money, but we have these small members, and we are going to limit the number of these members. So ideally, in the US, we cannot have more than 100 people forming an S corporation. So we form a small company, we distribute profits amongst themselves, and we call each member a, a member, or each partner, or each a person who forms that S corporation as members. Is it a flow through taxation? The answer is yes. S corps do not file a tax paying return, they just give you an information return via Form 1120S, and the income from S corporations gets distributed to the members on a per share, on a pro rata basis. We'll talk about it when we discuss S corporation. So per day, per share basis, the income flows through. The members will take that in their personal income tax return and then pay tax on it. Then we have the third kind, and this is really important. These are separate tax paying entities. So these are entities who report their taxes, who submit a tax return, and they are liable for paying tax. So one such entity, we have two such entities in the US. The first entity is a C Corp. So these are big companies. These are equal to public limited companies as we have in India. So what are these companies? These are companies who go to the open market and raise shares, and then their shares are freely transferred. So in all of the earlier forms of businesses, we can't transfer the stake very easily. But C Corps are a corporation form where the liability is limited, and at the same time, you can have transferability of shares as and when you want. Now, this is the key word, guys. It has double taxation. Now, in India also nowadays, the dividend income is has started getting taxed. They started a little slow, and they put so there are some thresholds, but even India is slowly moving towards double taxation for C corporation income. Now, how is it double taxation? Let's say we have Unilever PLC. Okay, so let's say Unilever PLC is going to go and declare. So it has lots of shareholders, and all of these shareholders pool in money in the company. Now, when company generates income, that income goes and rests in their reserves and surplus. And then when the company wants to declare dividend, lately ITC declared a dividend in India, HDFC, most company, ONGC declares dividend. So let's say the company declares dividend. When the company declares dividend, now see what is happening. Let's say if in a particular year, let's say $10 billion was generated by Unilever as an income. These are hypothetical figures. Okay, so this was the taxable profit. So what would happen? Unilever PLC would pay tax on the income that it earned. But when this money goes out and when this gets distributed as dividends to the shareholders, shareholders will again pay tax on that dividend. That is why we say that a C Corp formation attracts double taxation in the US. And that's the reason why most smaller companies wouldn't want to get and form a C corporation. Why? Because it will be doubly taxed. So if there are a limited number of people forming a company, it makes more sense to have a single taxation via flow through entities rather than double taxation, because in this case the same amount of money gets taxed twice, once in the hands of the company and the other time in the hands of the shareholders, which is the form 1120. What is the due date? The due date is 15th day of the fourth month following the close of the tax year. So generally, if your financial year ends from January to December, so December is the year end, Jan, Feb, March, fourth month is April. So 15th April becomes the tax filing, the deadline. So remember, C Corps are separate tax paying entities. Then we have these estates and trusts. When we were doing part one, a very small part we did there, but even estates and trusts have a separate return. The 706 and the 1041, and they pay tax on their own income via the estate and the trust. Are they doubly taxed? The answer is no. So see, this is how a typical estate would look like, or a trust would look like. There would be a person who would be a founder, or the person who would initiate a trust. When that trust is formed, the money goes to the trust. There would be a trustee who would be appointed. So let's say parents made a will, and in that will it said that in case if there's a child and if something happens to the parents, then the property of parents till the time the child reaches 18 years of age will vest with, let's say, the uncle. And when the child becomes 18 years of age, the money would go to the child. And so the uncle becomes the trustee, the demised parents, they become the founders, and the child who's a minor becomes a beneficiary. So what happens every year when the money is generated in the trust because of various sources of investment? What would happen? There would be an income from that. And when that income would come, who pays tax on that income? The trust. And if that income is distributed to the child, okay, if that income is distributed to the beneficiary, you will see it's either the trust or the beneficiary who pays tax, not both. So even here, we have single taxation. We don't have double taxation even in trusts and estates. So the only entity in the US which has double taxation is C Corps. And that's the reason most smaller companies would be extremely skeptical in being treated as a C Corp, because they will have to pay a huge chunk of money as tax to the government. Is this clear? The overview is clear from the tax angle. What are disregarded business entities? Sole proprietors. The business and the entities are not separate. What are flow through business entities? All forms of partnerships and S corps are flow through entities. They do file a return, but that return is only for information purposes. They are not separate tax paying entities. And then ultimately, the amount, which is the earnings, goes into 1040s of the individual members or partners, and they pay tax on it. C corps are separate tax-paying entities and they have double taxation. First, when the income is generated in the hands of C corps, and second, when this money gets distributed in form of dividends to the shareholders.